Hi everyone, this is Business Finance 2 class. Chapter 6 is International Financial Management, and today we are going to summarize the key concepts in this chapter. International Financial Management chapter will explain us what is the globalization and what are the effects of globalization to multinational corporations. And then we will talk about the multinational corporations and foreign exchange market, in the end international capital markets. Globalization has affected the culture, the social and the economic structure of nearly all of the societies, and companies are moving factor. Companies are very effective on the societies. So also globalization and companies together affect how goods and services are produced, how they are distributed, and how companies are financed. International financial flows are created through several means, the most important of which are the international trade and international investment. Companies sell their products and services to other countries. This is called international trade, and if a company really invests in this company, this is called direct investments. There are so many ways of financial flows. In this slide, we see type of business according to the balance of payments. We have payments for goods and services, salaries for non-residents, income from investments, current transfers, and so on. In the second box, we see economic relations. We have international trade, investment and credits, speculation, and balancing. And in the green box, we have functional purpose. Functional purpose of a financial flow which is international can be entrepreneurial or can be loan. A company can borrow from outside, or an investor, an entrepreneur can invest in an outside country. These are two different functional purposes. The orange box shows terms of relations. Can be short, medium, or long term in the time horizon of a flow. And the last box shows form of ownership regarding the sources of financial flows. It can be private or official, directed both ways. So we have different flows at different aims, different relations, different structures here. And then we have multinational corporations in the middle. This figure shows us these kind of relationships and markets. So there are 4 categories of multinational corporations existing. First one is a decentralized corporation with a strong presence in its home country. This is a multinational company, but basically its presence is in its home country. The second category is a global centralized corporation that acquires a cost of advantage where cheap resources are available. This is the second category. The third category of multinational corporation is a global company that builds on the parent corporation's research and development efforts. It is mainly in the manufacturing industry. The fourth category is a transnational enterprise that uses all three categories mentioned above. So we have these four categories, and we have here large companies and institutional investors linked to derivative markets and major banks. There are local and small banks, stockbrokers, customers, and small corporations and institutions. We have here small corporations and larger companies, and we have institutional investors who are investing in those companies. We have to think all of them together. So what are the types of securities in international capital markets? There are the bond market and the stock market. As we know, who are the participants? Primary users of bond market and stock market are issuers of capital market securities, which are governments and corporations, and the government needs long-term funding in order to finance infrastructure and other projects, as well as budget deficits we saw in the first chapter. The corporation's issue of bond or a stock has been known as the most deterministic funding decision to issue bonds or stocks for a company. So the participants are government and corporations. The distribution of a firm's capital between debt equity was named as capital structure as we know it. This is the summary of Chapter 6, International Financial Management. We haven't talked about the exchange rate risk with you in the summary. So in the end, I want to talk a bit about the foreign exchange rate and foreign exchange risk. The major determinants of the foreign exchange rate are parity conditions, infrastructure of countries, cross-border investments, and political risk and parity conditions. So, three approaches that explain the foreign exchange are expressed as the balance of payments, the law of one price, and the purchasing power parity, which you can find all the details in our book and our study resources in the E-Kampüs. And lastly, main types of exchange risks are transaction risks, translation risks, and economic risks. These are important concepts about international financial flows and also international financial managers. Thank you.